Hello and welcome to Lesson 4, Basis and Cost Recovery. By the end of this lesson, students should be able to describe basis and adjusted basis, understand basis of property received, describe makers, understand the expensing policy, describe the Special Elections Section 179, and understand amortization and depletion. So basis is an important concept in taxation because basis helps determine taxable gains and losses and therefore taxes paid. So basis is broadly defined as what one pays for an asset plus adjustments. And for additional information on this topic, you can read about it in IRS Topic 703, which is found at the hyperlink listed on the slide. Now, taxable gains and losses aren't exactly the same thing as realized gains and losses, but we need to calculate realized gains and losses in order to figure that taxable gain and therefore the tax. So let's define realized gain or loss. A realized gain or loss is the difference between the amount realized from the sale or other disposition of the property and the adjusted basis at the time of sale or disposition. Now note, we're not just saying sale here, we're also saying disposition. So realized gains and losses can result from relinquishing property, not necessarily through a sale, but by other means as well. So we talk about the amount realized. What is the definition of amount realized? It's the sum of any money received plus fair market value of other property received. So again, amount realized is not just necessarily the sales price. It's not necessarily the cash received, but it's basically the value of all consideration received in exchange for relinquishing that property. We'll talk about a variety of different basis terms, and so we're going to start out with original basis. So original basis depends on how the taxpayer acquired the property. In a purchase, the original basis is basically going to be the purchase price, and that could be cash or other property. Gift basis generally is carryover basis, so the basis in the hands of the donor becomes the donee's basis. Inherited basis generally is a step up in basis. And also remember that the assumption of debt does affect a taxpayer's basis in the property. So once we've got original basis, then there are adjustments to basis that happen along the way. So capital additions add to basis, and this could be money contributed to the property, so capital improvements in the case of fixed assets, real estate, land. It could be reinvested dividends, where tax is paid on the dividends that a taxpayer receives in a common stock, and then those dividends are reinvested in the company. So that would be an adjustment to the basis of that stock. And decreases in basis typically result from depreciation, and we'll talk about depreciation at length a little bit later on. So as I mentioned previously, gift basis generally is a carryover basis. Whatever the basis of the property in the donor's hands becomes the donee's or the recipient's basis as well. Now, if this gift results in gift tax being paid, then a portion of that gift tax often gets added to the donee's adjusted basis. And also remember that there are some special rules regarding generating a realized loss on the sale or disposition of gifted property. So refer to your textbook for the details. They are complicated. And know that when a taxpayer disposes of gifted property, you have to be very careful if that is resulting in a loss. Inherited property. The basis of inherited property is generally the fair market value at date of death. We tend to call this a step up in basis. We use that as shorthand, but it could be a step down as well. So it is fair market value at the date of the decedent's death. And the nice thing about disposing of inherited property is that inherited property is always considered to be long-term. So if your client receives some stock as an inheritance on November 1st, and they want to immediately dispose of that property, say November 30th, convert it into cash or use it to buy some other type of common stock. Even though the property has only been in your client's hand, the recipient, the person who inherits the property, for 30 days, certainly less than a year, that taxpayer, your client, will receive long-term capital gain treatment. So that's one benefit of receiving inherited property. So we've talked about original basis, we've talked about adjustments to basis, which would yield an adjusted basis, but let's talk about unadjusted basis. So unadjusted basis is a concept that we use usually in the context of depreciation. And unadjusted basis is the value that we use in order to determine what will be depreciated. So you may ask, can a property have more than one basis? And the answer is yes, and typically it is property that's depreciated. So there are several depreciation systems that run parallel to each other. There's the regular depreciation system, which is the one that we'll spend most of our time learning about. There's also a depreciation system for alternative minimum tax, and there's a depreciation system for adjusted current earnings. So it's possible that one asset could be depreciated using three methods, because there are three ways to compute tax for some corporate taxpayers, and that results in property having more than one basis. So we've talked about capital gain property. We've talked about business property, which is depreciated, but let's take a minute to talk about some investment property and the basis of pass-through entities. So the basis of pass-through entities is very important because it determines whether losses generated by pass-through entities are deductible. This is called the at-risk concept or at-risk rules. We'll spend a lot of time in a few weeks talking about the at-risk rules at length. So just know that just because your client owns a pass-through entity that is generating losses, that doesn't necessarily mean they're going to be able to take those losses in the current year. And then the other thing to remember for this week's lesson is that basis can never be negative, and that's true of any type of property. It's true of pass-throughs, it's true of other investments, it's true of business assets, it's true of capital gain property. So stay tuned for future weeks for more information about the at-risk rules and how basis plays into that. Now, in previous weeks, we've talked about community property in the context of divorce or marital discord. So we've talked about community property and how that affects maybe the innocent spouse rules. We've talked about community property and how that affects a divorce settlement. But community property also has ramifications upon the death of a spouse. So when a spouse dies in a community property state, or when community property is held, there's a tax advantage because the entire value of that property gets a step up in basis rather than the one half of the property that would get a step up in basis in a separate property state. So let's take a minute to think of an example and how that might apply. Let's think of a married couple who owns their home jointly. In a community property state, when the first spouse passes away, let's say that's the husband, the value of the entire home is stepped up. So if the cost basis was $100,000, the value at the date of death of the husband is $500,000. The basis for the surviving spouse, the wife, is now $500,000. That's in a community property state. Now, in a separate property state, only half of the property, the half that belonged to the husband, gets that step up in basis. So in my example of the home, one half of the property gets the step up in basis, so that's half of the value, $250,000. And then the surviving spouse's carryover basis would be $50,000, which is half of the original basis. And so the basis of the property in the hands of the surviving spouse is $300,000. So here there's a great benefit if you have appreciated property for owning property in a community state when one spouse dies. Now again, just like with the inheritance rules, we call it step up in basis as shorthand, but it's really adjustment to fair market value, and so it is a double-edged sword. If the fair market value of the property is less at the date of death than the adjusted basis, then you do get that step down in property. And when it's community property, it is stepped down on the entire amount.